This will be fun. Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, I'd like to make an urgent warning to PayPal investors. This is quite a polarizing stock. There's a lot of very bullish takes and a lot of very bearish takes. There's a lot of noise around the stock. There's a lot of people that are very optimistic about the future of the business, how they're going to roll out this ads business, how they're going to monetize Venmo and do all these different things. And it's going to finally result in a good stock return. And so in today's video, I kind of want to digest that. Judging by the title and my tone, you could probably tell that I'm not particularly bullish about the company. But at the same time, I do think that the stock and the business could be two different things. And actually, given the valuation and stuff like that, we'll dive into this later in the video. But I do think even if a lot of things go wrong, you might still be able to squeeze out a decent return with the stock, given some different variables. Now, to clear it up right at the start here, I do have a history with PayPal. My average on PayPal in, I want to say, April of 2023 was around $67 per share. I sold it at $60 per share and swapped it for, like every single penny of it, I swapped it for Google at $132 per share. This tweet is over a year old, but unless you've been living under a rock, this has only aged better as time has gone on. Google today is, I think, $240 per share, something like that. It's done well. It was a good trade. It was a good swap for the other business. I think more importantly, it was a good observation on my end to see that for a little bit higher of a stock price, I get a way better business in Google and way better risk to reward. Now, with that being said, I do want to turn this video into sort of three different segments. The first segment is sort of trying to understand PayPal from a business standpoint, try to understand it from a qualitative standpoint, where the company is today, how do they primarily generate their revenues, how do they primarily generate their profits. That's a key point to that equation there. And then more importantly, what are the trends with all these different business lines? Because it's honestly a bit of a mini conglomerate with all these different sort of payments companies within the business doing various different things across fintech. And so we're going to spend a decent amount of time with that and by extension to that, all the increased competition that has come over the past roughly 5 years and so, and how that has started to impact PayPal, what they're doing to kind of pivot their business. Item number 2 is we're going to look at the fundamentals because the numbers are, of course, very important for a business like this as well. I have a bit of a gripe with the amount of growth that the company has. And then lastly, I want to look at how the stock can actually still kind of work out, if a certain couple things happen. So with that being said, PayPal kind of gives us a roughly 3-segment breakdown into their business, which, for a company that owns 15, 20 different assets that they've acquired over the years and this and that, not a lot of color in terms of what we're getting in each different segment, but anyways, I digress. And then at the bottom here, which this slide in of itself makes it incredibly confusing, they just add Venmo. So the sum of these three right here add up to 100% in terms of TPV. But then these two at the bottom here are just sort of like side things. Like it's not a sum total. It's just like an extra breakdown as to like what, for example, Venmo makes. And anyways, it's a bit stupid if you ask me. But anyways, so branded checkout, which is by far the cash cow of the business. This is just literally the PayPal button. So if you go on Gymshark, for example, right? And then you click that PayPal button, you pay with PayPal, PayPal charges 3%, you pay for it, and boom, that's how PayPal makes money. 3% take rate business. This makes up for, I believe, over half of the gross profit of the business. So this is by far the highest margin segment of PayPal. And as you can see, it looks like, at least in the the most recent year, it was the slowest growing segment of PayPal, roughly the same as the next segment here, the peer-to-peer, P2P, and other consumer. And then if we look at the footnote here, it says P2P and other consumers TPV comprises of PayPal and Venmo, debit, PayPal, and Venmo, except when used to fund a branded checkout online transaction and remittances. So this is when, you literally if you go onto PayPal and you send somebody else money and then you choose to pay them instantly instead of waiting a day or two or whatever the case is, that's the money they make there. I would assume grouped in here would be foreign exchange as well. So if you receive money in American dollars, you want to change it to Canadian, they charge you, I think it's 3%. So, compare that to Wise, which charges you 20 basis points. Anyways, that 3% that you make there, I would assume this gets included in that segment there as well. This is also probably a very high margin segment of the business. And then you have payment service provider. This would be Braintree. If you don't know what Braintree is, you could imagine it as essentially a payment processor. So I believe actually Uber uses them. So every time you order an Uber, you're actually putting a little bit of money in the pocket of something like PayPal, because the way that the merchant acquirer bank that kind of receives those funds and then Uber can withdraw it into their own bank is Braintree. And then of course, Braintree is owned by PayPal. If that didn't make too much sense, just Google it. It's essentially a PayPal wallet, but just for enterprises. So like, you know how like if I was doing like video editing work for somebody in the US and they pay me through PayPal, that obviously goes on my PayPal wallet before I withdraw it to my actual bank account. That is essentially the relationship of Braintree and big enterprise customers. It's like a median wallet for them to then withdraw into their main bank account. And so this is the lowest margin part of the business, but accounts for the biggest portion of total payment volume. And so I guess we could kind of touch on these one by one, but the two that I'm very worried about is number one, branded checkout, because it has started to become obsolete. In a world where off my phone, if I ever go onto Gymshark and I want to order, gym clothes, whatever the case is, if I go on any e-commerce website, doesn't matter, right? And I want to order anything, I have Apple Wallet, boom, boom, double click the side button and it instantly pays for me. No problem. If I'm on my laptop or if I'm on my computer, whatever the case is, and again, I'm ordering something online, I'm ordering clothes, I'm ordering an IKEA bookcase, okay? Whatever the case is. Headphones off of Sony's website. It could be whatever. When I'm ordering that, because I've entered my credit card once into any website, this little Google icon comes up and it says, oh, would you like me to save your card details so you don't have to type it in next time? Because it's tedious for you to go find your wallet and then bring your card and then one by one make sure, 3196, whatever, right? Like, it's tedious. Do you want me to just save it so you don't have to do that? And you're like, yeah, absolutely. Save that. No problem. It's Google, right? I trust Google. And so you do that and it immediately makes PayPal obsolete. Where does PayPal make half of its gross profit? From branded checkout. In a world where your credit card details are saved in your Google wallet, and then in addition to that, in your Apple wallet, you have obviously like your card details saved there as well. Why would you ever pay any transaction fees to load your wallet with a PayPal, to load your PayPal wallet, or to load, or just pay any transaction fees or foreign exchange fees or anything like that with PayPal? Why would you ever go through PayPal? In fact, even if it was free to do all those things, which in a lot of cases it's not, why would you ever go through the extra hassle of sending money into a PayPal wallet? There's absolutely no incentive for you as a user to do that, especially once you see that little icon that says, oh, within literally one click, you could just pay with your credit card that's already saved here that gets you rewards and whatnot. There's going to be some people that comment that say, oh, but PayPal also does cash back, but for the large majority of people, they don't communicate that. And even if they did, consumers are a lot more simple than that. They're just going to use their credit card. I would say I'm probably one of the most insane people when it comes down to credit card points and stuff like that, where I'm trying to optimize, let me use this card for this transaction. Oh, I get a 1% cash back on, regular spending with this card, while this other one gives me 0.8%. Okay, let me optimize and use the other one, right? I haven't even bothered to go after something like PayPal and even look into it. So that's number one. They are fighting an uphill battle. To deny the fact that they're a legacy provider in this business, they're fighting against innovator's dilemma. To try to deny that would just be naive, frankly. This is a fact that is a legacy business where less and less people are using it. They are having their market share taken away. I think globally there's maybe a use case for it. I'm speaking as, like a Canadian consumer here. I believe in Germany, they're very big and the culture there is to use it and stuff like that. So I'm sure there's pockets in the world where it's going to get a lot of usage and a lot of people use it and this and that. But speaking company-wide, worldwide, this is a losing battle, at least on the branded checkout side. Moving on. When it comes to, again, the peer-to-peer paying each other and stuff like that, I feel like most people just do the option where it pays for free in like 2 days. Not that big of a deal. I would love to see the operating margins on this line of the business, but I'm almost certain that they don't break that out because it would be a disaster if they did. Sure, they probably have decent gross margins on that. It probably contributes to a good amount of total payment volume growth. It probably contributes to a decent amount of revenue growth. How profitable is it that you're making these transactions, that you're sending money among different wallets and stuff like that? You could make the argument that it kind of builds the flywheel in the other segments of the business, and that's great. You know what? That's good. But in of itself, it doesn't probably generate that many profits. And then more importantly, embedded in this segment is the fact that, again, you're probably paying some sort of transaction fees when you send money to other people, or when you have to convert that money from Canadian to USD or whatever the case is, charges you 3%. This, from my own experience, it charges me 3%. Guess what I did? I hooked it up to a Wise wallet. Have you guys heard of Wise? This is not some small competitor, by the way. They are a 10 billion pound market cap. I think that translates to like roughly 15 billion American dollars. Do you know what the weighted average take rate of this company is? It's on average about 1%. In my experience, I've actually seen it as low as maybe 0.3, 0.4% for me to convert my Canadian to American or vice versa. So this is just a straight up case of innovator's dilemma. If PayPal is charging you 3%, why in the world would they just drop that to 1%? That's immediate profits that are going away from the business. Immediate. And that's very high margin revenues that would be leaving the business. So that's, again, another I chalk it up to they're going to be a casualty of innovator's dilemma within enough time. It might not show up this year. They might be growing mid-single digits over the next couple of years. Eventually, it will catch up to them. There's Remitly, there's Revolut, there's Wise, there's probably 5 other ones that I haven't even heard of, but people, millions and millions of people are probably using them that you and I are just not aware of because, we don't send money internationally, whatever the case is. But they exist. It's very competitive out there. And they have taken the statement, your margin is my opportunity, to a literal maximum. Why would PayPal ever drop their take rate on stuff like that? They frankly wouldn't, and over time they're going to get disrupted. This is just a fact. Lastly, I would say the crown jewel of PayPal, I think what can actually maybe rescue PayPal over time, the PSP business, the payment service provider. They're a competitor here with stuff like Adyen and Stripe, and I think this business has the most potential out of everything that PayPal has. It's growing pretty decently. It's growing about 15% year on year. Granted, it is bringing down the gross margins of PayPal, so that's not necessarily a positive development, but at least it's a business that, even though there is probably a good amount of competition out there, there is high switching costs when it comes down to it. They try to be a cost differentiator. So something like Adyen, they focus on having the highest authorization rates. Braintree doesn't necessarily focus on that. They try to be the cheapest option for enterprises. And then obviously once, a company goes with Braintree, then they tend to kind of stick around because it's pretty difficult to switch a payment provider once you end up choosing one. The analogy I like to give there is like once you choose a bank, it's pretty difficult to switch away from that bank. And that's you as a single consumer. Now imagine a company with, real products, hundreds of employees that come in and interact with selling their products and so on and so forth. It starts to get complicated after a little bit, right? It's not an easy task is the point I'm trying to make. And so that portion of the business does account for 40-something% of total payment volume. But again, I would imagine the gross margin on this cannot be higher than 20-30%. Compare that to something like branded checkout, which probably has 70-80% gross margins. Over time, the quality of the business is deteriorating here. Add on the fact that, obviously this is a very competitive space. I would argue probably across the business, they have equally competitive industries that they're competing in. So on that front, maybe not too big of a deal, but the fact that, it's obviously better to be in a higher margin business than a lower margin business. You look at something like Shift4 Payments, right? And this isn't a one-to-one comparison, don't yell at me, but this is also another payment service provider company that focuses on being a cost differentiator. You look at their gross profit margins. Oh, would you look at that? It's about 30%. What did I just say? 30% gross margins is probably what Braintree is. So overall, to summarize this first segment, they're getting absolutely screwed in terms of the peer-to-peer payments and the branded checkout. Those two businesses, it's only a matter of time. If it doesn't happen next year or the year after that, within 5 to 10 years, this business is probably going to start declining. In fact, I think in the most recent quarter, we did have close to 0% growth on that front. It's not looking good for PayPal. I'm just going to say it like that. Yeah, so not the most recent quarter, but the quarter before that, we did have 1% revenue growth in Q1 2025. So came very close. We came very, very close to having negative growth on PayPal here. And so to kind of close out this first segment, the saving grace. Yes, Arya, we understand their current businesses are completely screwed. From a competitive position, they're going to start declining. This is a dinosaur business, everything, great. But Arya, we have advertising. PayPal is going to get into advertising. They're going to become a juggernaut, and it's going to be the saving grace of this company. That's how PayPal stock will eventually go back higher. They're making so many buybacks. Things are going to improve with these advertising. They're just going to spawn an ads business by next weekend, and everything is going to be sunshine and rainbows. We're going to be fine. Even if by some miracle they could, develop the advertising business within a couple months, call it even a year. Right? I'm exaggerating by saying next weekend. Even if they could, by some miracle, develop a proper advertising business within, a couple quarters to a year, maybe, they have a very massive issue with the fact that this is not an Amazon. This is not a Meta. This is not Google. And the reason I say that is when you look at any great advertising business, and by the way, I get this from the Intrinsic Value podcast. They did a fantastic episode on PayPal. They're quite bullish on it, but my takeaway of it was to become even more bearish on the business. But anyways, they did a fantastic job explaining how with a great advertising business, you kind of need 2 key elements. And I would argue you actually need 3 key elements. So element number 1, you need a lot of data on your customers because ultimately you need to know, Arya likes to go paddleboarding. Let's give him an ad for paddleboarding. Arya likes golf, so we should give him an ad for, golfing gear, whatever the case is, right? So that's element number one. You need data on your customer on what they like. I would 100% say based off shopping habits and stuff like that, PayPal has that sort of data. They can very quickly identify what type of things you're into based off of what you shop for, right? Or what you might be interested in. Item number two, you need the other side of that coin. You need a lot of people that want to place ads, right? So it's great that Arya likes golf, but do we have 1,000 different golf brands and golf related items that we can choose from and show the most targeted one to Arya? Could we show him within like 5% accuracy what he likes among all these different golf related ads that we have here? Could we show him the top 50 golf ads or whatever the case is, right? Maybe in the case of PayPal, it would be less frequency, but I'm talking in the terms of like something like Meta, right? Like over, if you're scrolling Instagram, you're going to see a lot of golf related ads and stuff like that, right? Anyways, item number two, PayPal, without a doubt, they definitely will have a lot of traction when it comes to golf-related ads and having a lot of advertisers on there. Now, number three, where they fall short massively, they don't have any surface area. What I mean by surface area is when you go put a Google search, Google has those 4 listings right at the top that they could show you an ad. When you go and you search for pizza in the Uber Eats app, Uber has that top result that's an ad by Domino's or Pizza Nova or whoever, right? Amazon, you search for an iPhone charger, boom, first 4 listings, iPhone charger. Meta, they have that vertical scroll. As you scroll, every 10th video, they show you an ad. YouTube, they have the real estate, surface area, you can think of it as real estate. They have the real estate of showing you an ad every time you open a YouTube video. And they show you a quick little ad. What does PayPal have? When you open the app, sure, they could put an ad there. That's what Expedia does, right? Expedia, Booking.com, they put an ad as soon as you open the app. Additionally, when you're searching for something, they put a little ad saying fly with Turkish, whatever, fly with Emirates. Okay, that's not, that meaningful. It's not going to move the needle, right? I mean, come on, it's just a display ad. Okay, what else do they have? The genius idea, CEO of this company, the C-suite, not even the C, I actually quite like the CEO. The C-suite of this company, the genius plan that they came up with was, we are going to make, the shop app from Shopify, where you could go onto the shop app and then you see all these, items that you can buy from Shopify stores around the world. We're going to give visibility to our Shopify merchants, right? The genius idea that this $60 billion market cap company, C-suite, getting paid 10, 20, $30 million per year to figure this stuff out, what they came up with was, we're just going to copy the shop app. We're going to make a tab inside the PayPal app where you could go and you could see items that are being sold by PayPal merchants. That's what they came up with. Ladies and gentlemen, they reinvented e-commerce and they decided to put it in the app. And what we're going to do with that is we're going to introduce advertising. So when you go and you search for whatever, or you give them priority listings, I don't even know how they're going to incorporate this and make it successful. So you're going to just give them priority listings based off people that spend ads and then try to target that. So Arya's into golf gear. He's going to open the PayPal app. He's going to buy some miracle. Why would he? In the year 2025, when Amazon is a thing, when eBay is a thing, eBay's a dinosaur in of itself, but it still exists. People still shop on it. You've decided to reinvent e-commerce in the year 2025. That is your genius plan on how to monetize the PayPal app. I'm genuinely speechless as to how stupid this execution plan is. If this actually works, if PayPal can get meaningful traction, matter of fact, I'll donate my portfolio to the top charity that is listed in the comments down below. That's how confident I am that they're not going to be successful in reinventing e-commerce. It's just ridiculous. Anyways, we've gone on way too long, but to kind of bang the next 2 segments of this out, let's talk numbers here, right? PayPal, and I'm not even going to look at the current numbers because they're frankly embarrassing, right? Like 1% revenue growth. Brother, achieve GDP growth at least. You know what I mean? 4% revenue growth over the trailing 12 months, absolutely embarrassing. So I'm not even going to look at that. I'm going to look at their own guidance that they've guided for over the future, right? And this is, again, just hilarious to me because I feel like the PayPal investor base kind of cite these numbers as if it's like absolute certainties that it's going to come true. Again, it's the line of thinking of like, oh, look at how successful Uber and Amazon were at advertising. They did so good. So the same thing's going to happen to PayPal just because, all advertising is the same. Just sheep thinking, literal sheep thinking, just hive mind thinking of it's just going to work out. And it's not that simple. Again, there's a chance they do decent with it. Maybe there's a chance they could, an idea that I saw that got floated around, which I actually like, I think maybe this is how they can figure out advertising, is if in your email receipts, because PayPal sends you an email receipt, in the email receipt, they say, oh, shop this similar item. And then that's an advertisement. I thought that's the best thing I've heard so far. You know who that came from? The Intrinsic Value podcast. That didn't come from any of the materials I read from the C-suite of the podcast. A podcaster can figure out company strategy better than people who get paid tens of millions of dollars. And I don't mean to undermine the guys at Intrinsic Value. I think they're very smart people. But I think, we're worlds apart in terms of responsibility here, right? Like, just stupid. Anyways, let's look at the actual growth of this company, right? They say that they expect transaction margins to grow by 10% plus over the longer term. Now, this doesn't translate to revenue growth directly. The revenue growth will always be a little bit less than transaction margins. And I can show that to you two ways. Going on over to the world's greatest stock research platform, which is, of course, fiscal.ai. Using the link in the description down below, you can get a 2-week free trial, no card required. I could show to you the transaction margins of this company. Excuse me, what I meant to say is the take rate of this company, right? And as you can see, because the Braintree business is lower margin than the legacy business of branded checkout, what do you notice about the trend with these take rates here? Oh, it looks like it went from 3.5%. That was the average amount of money that they were taking off of any PayPal transaction in the year 2013 when they IPO'd. 2014, I think they IPO'd. From taking 3.5% every single year without a stop, without missing a beat. It has consistently gone down. And luckily, over the past 6 months, it seems it has started to finally flatten out a little bit. So I think this is a result of we're coming closer to where the Braintree take rate is. And so maybe the Braintree take rate is about 1.7% on average. So it's starting to flatten out, right? So because of this take rate always consistently going lower, you have your TPV, your volume and stuff like that. That grows a little bit faster, revenue a little bit slower. Now, they expect, on top of this roughly 7-8% revenue growth until 2027, which they expect to reaccelerate and stuff like that, great, whatever. They expect to translate that to a low teens non-GAAP earnings per share growth. I've looked at their non-GAAP item, or their non-GAAP adjustments and stuff like that. It seems to be pretty clean, but, a little bit questionable. They're using non-GAAP, but it seems to be, it's a clean number, okay? So they expect low teens EPS growth rate, and they expect that through a mix of, 6% shares outstanding reduction and a little bit of margin expansion. So going back to the number I just mentioned, that means that, with the 6% buyback roughly, a little bit of margin expansion, you end up with like 5-6% revenue growth. Because if you add those numbers up, it'll equal roughly a low teens amount with ambition for 20% longer term growth. So going all the way back to the thing I said where, it's like hive mind sort of thinking with these PayPal investors. Just because they say they have ambitions of 20% longer term growth doesn't mean it's a guarantee they'll achieve it. I pray for you that they're going to achieve it over the longer term, that they figure out how to reinvent e-commerce and advertising. But that's not a guarantee. It's not necessarily going to happen. They're guiding for low teens. If you look at analyst estimates, roughly low teens. They've had over the past 2 years like a one-time reduction in terms of operating expenses and stuff like that. So that artificially has boosted the growth rates recently. It's not a good, if EPS is up 40% year over year, it's not a good proxy of growth for the next couple of years. If your revenues are growing at 5%, your EPS can't grow at 40% for multiple years. That's just how math works. So anyways, you go through all this trouble, you're holding a business that is competitively disadvantaged, that's going to be disrupted over the next decade, all for the hopes of squeezing out a 10-11% earnings per share, 12% earnings per share growth rate, primarily driven by not organic growth in the business, no, by buybacks. And that brings me to my next point. Even the buybacks are a little bit inflated. People say, oh, look at them. They're putting, $6 billion of, how much are they actually putting? Let's take a look. Total shares, repurchase. There we go. Common shares. Yep. Oh my God, look at them. They're doing $6 billion of buybacks. So many buybacks. At this rate, they're going to buy back the whole company. Until recently, it was like a $60 billion company. So, the buyback yield is like 10%. They're buying back 10% of the company every single year, right? You pull in the buyback yield here. Again, would you look at that 9, 10, almost 12% at the peak here in April, right? No, it's misleading. They do a lot of stock-based comp. If you look at the reduction in total shares outstanding, which is, by the way, how you should be measuring the buybacks, it's about 6.5%, which, oh no, okay, it's actually, okay, about 7%, which is pretty good. Like, that's a lot of buybacks. That's great. Maybe they can be a share cannibal, and that would be great. But then again, like, what if over the next 3 years, okay, they achieve the low teens EPS growth rate, great. What if, because the company is fundamentally being disrupted, this is a fact, it is being disrupted. What if over the next 3 years, the revenue slows down to a low single digits rate, starts to go to 2, 3%, stops growing? How about that? They can't figure out the advertising thing because, again, I don't think they have surface area other than like the receipts idea, which is a pretty brilliant idea. What if it goes to like a 0% growth rate? What happens to your stock at that point? Are they just going to turn into a full-blown cannibal? So the goal here is, as an investment, for this company to trade at a 12 PE so that they can buy back as many shares as they can, so roughly 7, 8, perhaps 9% of the stock, if it continues to dip a little bit more. That's what they do. And that translates to, best case scenario, around 10% EPS growth rate. That is the goal of your investment here. They expand margins a little bit more, turns into a little bit more growth on that front. That's the best case scenario, about a 10% annual CAGR. Now, there is a world such as, what was it, fall of last year, where the stock traded up to like 90, was it? Yeah, December of last year, right? So about 10 months ago. There is a world where it re-rates back up to like, I think at that point it was like a 20 PE or something like that, due to increased optimism of they're going to do advertising, they're going to do this, they're going to do that, right? Let us zoom in until here. Actually, let's do one more. Yeah, so it was trading at, a low 20s PE. That's not too far off from where something like Visa trades at. I think Visa trades at like typically a 28, 29 PE. So still a little ways to go, but you get the idea, right? So the goal with this investment is to either have that buyback situation where they just buy back a boatload and they turn into a share cannibal, which those stocks do okay over time, but they tend to also grow revenues like at least 6, 7%. You know what I mean? On top of trading at a cheap valuation and doing 7, 8% in buybacks. Booking.com has done it. AutoZone, the other one that I'm blanking on the name on, O'Reilly, right? There's a couple of these stocks that have historically been able to do that, where they typically at least grow like high single digits-ish. PayPal doesn't seem to really have ambitions of doing that longer term. They can maybe squeeze out 5, 6% growth over the next handful of years. We will see. But I think the only way this stock really does well over the, call it medium term, 3 to 5 years, is if it, by some miracle, due to increased optimism over some new product that this management team comes up with, if it trades back up to a 20 PE and kind of stays there. That's the only way you get a decent return in this business. If it continues to trade at the same valuations based off solely the growth of the business, the competitive position of the business, this will probably not be that good of an investment. I will admit the downside is pretty low here. What happens? The valuation keeps going lower. It goes to a 10 PE, it goes to 8 PE. I don't think that's going to happen. And the fact that they have the buybacks working for them, those buybacks technically start to be a little bit more accretive if it does go to like a 10p. So they have that working for them on the downside. The point I'm trying to make, this isn't some runaway multi-bagger investment that you've discovered. This is not a meta-like opportunity, okay? There's a reason the stock has not done that well, where something like Meta, basically right away, within like 6 to 9 months, they cleaned up their act, growth lever turned back on, and boom, immediately. It was because they were kind of shooting themselves in the foot. This is external factors that are affecting PayPal. I can almost guarantee this will not be a runaway investment. Your best case scenario is they somehow figure out that advertising business. Braintree becomes essentially the entire business. It becomes the dominant, portion of TPV, revenues, gross profit, everything in between. That is the captain sailing the ship in the future. And then lastly, you have some version of the multiple goes up, or they do a whole bunch of buybacks that results to like a low teens sort of EPS growth rate. That's probably what you can expect out of this investment on a going forward basis for maybe the next 3 to 5 years. But, longer term, I think you're screwed here. Anyways, thank you very much for watching this all the way through. Even though I truly hate the stock, the business, everything in between, as a consumer, as a person commentating on, investing and stuff like that, I pretty much hate everything about PayPal. I will say, I don't like it when other people lose money, or, whether it's PayPal turns into an opportunity cost for them, they hold on to it for 3, 4, 5 years. I hope I'm wrong. I say that from the bottom of my heart. I'm not lying when I say this. I hope I'm wrong. I hope the advertising business somehow works and I missed something in my research. I hope the stock does well for you. I hope they irrationally trade up to a 23 PE over the next 6 to 9 months and PayPal turns into a pretty decent investment for you. Hopefully you sell when it goes to a 23 PE. Hopefully you don't get greedy. I hope these things happen. Over the longer term, This is not a business you want to be invested in. Plain and simple. This company, the moat is eroding. The company is becoming less competitively advantaged. This is a fact. You look across any of the KPIs on fiscal, they're declining, they're deaccelerating, they're getting smaller. The frequency in which people are transacting, the number of users that are coming onto the platform for the first time. You look at any of these different KPIs, they're not going in the right direction. Total payment volume has deaccelerated. Number of payments per account has started to go down. Look at this. Has started to go down. Take rate started to go down. Gross margin started. The only thing that has gone up is like the operating margins and free cash flow margins. And that's a result of them. Like if you look into the split of that coming organically from the business and that coming from them cost cutting, I think almost all of it is coming from them cost cutting, firing people, having less, corporate bloat and stuff like that. That's not a repeatable thing. It's not going to continue on forever. I wish you luck. I truly, truly mean this. I wish you luck with this investment. I hope I'm wrong in some capacity here, and you get a chance at getting at least some sort of a decent return. Selling in, the 90s, the 90s or the $100 range, whatever the case is. I hope in the next 6 months the company trades up to a 20-something PE. I truly, truly hope for that. Best of luck. Next time, don't buy a company growing revenues at a little bit above GDP over the hopes of a value play, cigarette butt. Hopefully it re-rates down a lot, whatever. If you like the authenticity and the honesty, you should join the Patreon. It is $3 a month. Unlike the thousands of dollars that holding PayPal has costed you, there is exclusive content. We have 300 investors here, and we have a great little community going on. So by all means, give it a try, price of a coffee, and you get direct access to me. With that being said, thank you very much for watching, and have a great day.